Ricken Financial presents Kickin' with the Rickens, redefining retirement. Gerry Ricken and Heidi Ricken Provost want to help you reach the retirement you deserve. Let's build a strategy that gives you the confidence while meeting your financial wants and needs. Meet the team at rickenfinancial.com. Now, Kickin' with the Rickens.
Thanks so much for subscribing, liking, downloading, Kicking with the Rickens, redefining retirement. RickenFinancial.com. My name is Mark Owens, Gerry Ricken, Heidi Ricken Provost. How we doing this week?
Good. How you doing, bud?
It's a great one.
It's a great day to be alive, baby.
Always a great day.
It's a great day to be alive.
You know, Travis Tritt has had this huge explosion in popularity. You know, I'm down here in Atlanta. He's from Atlanta. And he is, you know where he's most popular right now?
Where?
In the political circuit. Because we don't talk politics here. But he is a very proud conservative. And so he'll go to all these rallies with conservative politicians and play to crowds of 5, 10, 15,000. So, hey, man, go make your money.
Good for him.
Hey, good for him, yeah.
That's right. Good for him.
I ain't mad. Hey, we wrapped it up last week. Did you get all invested? Did you watch the Olympics every single night? I know in the Owens household it was on pretty much 24/7. What say you?
Definitely on 24/7 at the Ricken household.
Yeah.
For the last 22 years, we have been highly invested in the Olympics. Why is that, Gerry?
22 years ago, I got to run with the Olympic torch, Mark.
Tell me about that.
Well, it was the Salt Lake Games for 2002, the Winter Olympics, and I was nominated.
Would you like me to? Okay, so it was shortly after my sister Mary Beth had passed away.
Mm-hmm.
And my dad's old secretary in the early 90s, maybe the 80s.
Yeah.
Maybe the 80s.
Shout out to Kathy Schumacher.
Yes. Kathy nominated Dad to run the Olympic torch in memory of my sister.
Oh.
And we were in the hood of St. Louis, and he got to run
It was awesome.
for about a quarter of a mile. And basically everyone we knew came out and got to run alongside him and behind him as he carried the torch that is now in his hand.
And Mark, I actually was. Everyone who carries the torch gets to keep the torch, and you also get to keep your entire outfit. And they deck you out from head to toe, from your stocking cap to your gloves to your warm up to a T-shirt underneath, and except for underwear. I had to wear my
They
own.
give you socks, though.
I really thought you were going to say, so I just didn't wear any underwear. They didn't give me any. So I think, but were you nervous at all? Like, were you nervous about
Yes, I was. Well, I was nervous going into it, but then we were all on a bus, and they took us on these little buses around, and there were groups of us, you know, and they would drop us off at various points. So we got to talk and share our stories with everyone, and that really relieved the tension, if you will.
Yeah.
Because you got to be relaxed and you heard about other people's stories, and then by the time you got it in your hand, I mean, the most nerve-wracking part was receiving. You have to turn your torch. They turn your torch on. You don't. You're not in charge of it for safety reasons. But they turn the gas on your torch. Then you accept the flame from another torch bearer, and then at the end pass the flame on. And that was probably the most nerve-wracking part of the whole situation. Is, am I going to actually get my torch lit? Am I going to light the other person's torch?
like being an acolyte at church?
That's right. You had one job. So I had two jobs. I was receiving the torch. I had three jobs. Receiving the torch flame, running with it, and then passing that torch flame on.
What time did this happen? Could you see some of these?
It was in the evening. It was dark.
Yeah, it was late at night in the winter.
Yeah, in the wintertime. So it was probably about 7:48.
Specifically 7:48
yes,
p.m.
I do recall that, actually. So.
I think it was actually later than that because I have a horrific memory from my childhood, but I distinctly remember that day. And it was supposed to happen like 2 hours before it did happen. I remember we were waiting and waiting and waiting. We were like, when the hell is he going to get here?
Yeah.
You keep the torch at the office, so if somebody comes in, run with it if you want to. I don't know, do a lap around the building.
It no longer has fuel in it anymore because it may or may not have made multiple trips
around our neighborhood. At every opening ceremonies of the Olympics, we would take it, and I would run a lap around the neighborhood with it lit. So with my outfit on.
Hold it up again. Can you put like a Roman candle in there? Because please tell me on the 4th of July, you don't put some fireworks in there and shoot them off.
Oh, he used to run it on the 4th of July as well.
Yeah, I did. So, and the flame was amazing.
Every new client to Ricken Financial gets one weekend with the torch to do with That is fantastic.
Thank you. It was a very special time in our lives, and it was an incredible journey.
I love you got to do that. RickenFinancial.com. You can meet Heidi, Gerry, and the entire team. A big topic that I think it's going to take us a couple of shows to cover all the aspects of life insurance, because Heidi, you said that everybody's worried about it right now. You're fielding a bunch of phone calls, new clients, people are calling you up saying, let's talk more about this. So let's start at the very beginning, the importance of life insurance.
I've said it before. I'll say it again. You'll probably hear this 1,000 times from our office. Life insurance is a necessity because GoFundMe is not life insurance. You can't rely on the generosity of others to make sure that your benefits are covered and that your family is covered when you are no longer with us. Today, we want to talk about life insurance in form of death benefit and what the death benefit will do for you and your family. Let's start about a married couple who just signed the paperwork and has a mortgage. What does their life insurance need to look like?
How about someone who just graduated with $40,000 worth of student loan debt? If we start there, you may or may not have that covered by your employer, because a lot of people that we meet with, especially younger couples, believe that, oh gosh, my employer takes care of my life insurance. That is a woeful miscalculation if your situation exists where you have a mortgage. It may or may not cover student loan debt, depending upon what your loan debt is. But the importance of life insurance is, as Heidi said, it's crucial from a death benefit perspective, because when you think about life insurance, you think about death. Nobody wants to think about death, but you have to think about your demise and what will happen in the event that you do leave this earth, or when you do leave this earth. Is there a necessity for life insurance? If you are just graduated from college, you may or may not, just like I said, be able to just cover all of your debts with whatever your employer provides. Okay, but as Heidi just said, what if you just got married and you bought your first home? All of a sudden, life changes dramatically.
Yeah, exactly. So when you're married, and whether you have a family or not, but let's just say on this example, you're married. It doesn't matter what point in time you got married, but you have a mortgage, and there might be some other debts out there in the form of student loans, credit cards, car payments, something like that. The first step in your death benefit coverage is you need to make sure that you are covered in the event of your demise for all of your debts. That's step number one. So add up all of the debt and the interest on that debt. When we're looking at all of it, you want to make sure that your death benefit will cover that no matter what. But then beyond that, you need to do an analysis for your income replacement as well. So when you combine lives with a spouse, your lifestyle changes, because you're going from being single and having to cover all of your expenses on your own to combining two incomes. And you don't necessarily want your spouse to be left having to dramatically change their lifestyle because you're no longer around.
Because when one of you leaves the earth, 50% of your expenses do not leave the earth with you.
Oh,
right?
Absolutely. And we have that question a lot, actually. People are like, if I'm gone, wouldn't the expenses go down by like half? Well, if you're able to pay off the mortgage, that's great, and the expenses will decrease. But we found that over time, your expenses only decrease at most like 20% from the experiences that we've had with our own clients when their spouse passes away. So you need to analyze that and make sure that your death benefit covers step one, all of your debts, and step two, more than 1 year of income replacement. And if you only have 1, 2, 3 times your salary at work, you are going to be underinsured, especially if that doesn't even cover your debt to start.
Covering your debt is the first goal, and then income replacement is the second goal. So if you have 2 or 3 times your salary, that may or may even not cover your debt. That's completely.
Exactly.
I mean, it may not pay off your mortgage. The analysis becomes, what do I want my family's life to be when I'm gone? And that can happen today, could happen tomorrow, could happen 50 years from now, who knows? The most important thing is paying off those debts first, and then looking at the income replacement. What am I bringing to the table? What are my expenses going to be in the event, or my family's expenses going to be in the event that I'm gone? And what do I need to do to prepare for that so that my income is replaced, at least to a certain extent?
Of course. And so let's take it a step further, because if kids are in the picture, everything's going to change.
Right.
We have unfortunately known too many people through friends of friends one of the members of the marriage, they passed away and left children and their spouse behind with 1 times their salary, 1.5 times their salary at work. Seeing the surviving spouse and the children be uprooted from their lives, have to sell their home, move in with grandparents or parents or whatever the situation may be. That's been really tough just peripherally seeing that for people. So that's one of the reasons we wanted to have this conversation today, is because we never want that to be the case for anyone. And we don't want you to have to rely on GoFundMe or other streams of income or dramatically changing your lifestyle to make ends meet when you're already saying goodbye to a spouse or a loved one and grieving. You don't need to have compounded issues like that. So when kids come into the picture, you need to take your analysis a step beyond just debt and income replacement, because
expenses go up.
Yes.
For the family when children are involved. I mean, it's just a reality.
Especially if they're younger or on the brink of college or have special needs. There are a lot of different layers to that, but you need to make sure that your family is going to be protected and able to handle whatever comes their way. And $150,000, $300,000, $450,000, that's not going to cut it. It might sound crazy to some people, and we do have these conversations all the time, and people will say, you're telling me if my spouse got $600,000 tomorrow, they would not be okay?
That's a correct statement.
Exactly. And these are the same people who have $350,000 left on their mortgage and 2 young children at home, and they're, the spouse who is asking this question, like, my spouse is not going to be okay with that. They make $100,000 a year. Take a step back and think about that. $600,000 of death benefit is 6 working years of income.
Can I ask this kind of a dumb question? Did you hear about like life insurance? And, I have a $1 million policy, a $700,000 policy. Do you get taxed on that?
No.
Okay.
Death benefit of life insurance is not taxable.
Okay. That is not a dumb question. That is a great question, Mark. And that's the power of life insurance, is life insurance death benefits are always tax-free. So it's a way to truly cover your family in the event of your demise, because they don't have to have that addition of worrying about the stress of covering the taxes in order to utilize that fund.
Is there a right age for us to get life insurance? I know like it's easy to say, well, young couples getting married, they're probably not making a lot of money at the very beginning of their relationship. But is it still important to get it no matter what bracket you're in?
Yes, it is, Mark. And the earlier you start, the cheaper it is, especially with respect to term insurance. You can get a 30-year term policy as a 20-some-year-old for, a couple $1 million for pennies on the dollar. I mean, it's less than $100 a month.
Because the cost of life insurance is based upon your health and wellness. So if you're a young, healthy person, it's going to be a lot cheaper than if you're 75 years old and still have debts out there and need the coverage. But to answer that question, Mark, there is no particular tax bracket or age associated with life insurance. If you have debt and you don't have cash on hand to cover that debt, no matter what stage of life you're in, what age you are, you need life insurance to cover that.
As your life changes, your life insurance needs from a death benefit perspective change as well. Mm-hmm. So as your debts are paid off and your assets are growing, the need for death benefit for life insurance diminishes over time. So we analyze that every step along the way. In our annual reviews, we talk to people about that.
And there are all different types of life insurance that you can purchase to cover your expenses, your debts, your income replacement. Like Gerry just mentioned, one of them, term. Term insurance is the most economical way to cover your debts for the future for death benefit. And as it states, it is live for a term of your life. So it could be a 20-year term, a 30-year term. That means it's good for 20 years, 30 years. You pay premiums in each year to keep it alive. And at the end of that, you could either continue to pay the term at higher rates or it goes away. So, for simple debt repayment purposes, term is usually pretty good when you're a younger couple starting out and you don't have that much money and you need to cover it. The most economical way to do that is with term insurance, but there are other forms of insurance as well.
When you think about your life cycle you're in your 20s, 30s, 40s, 50s, and you have the burdens of debt and income replacement. That's an important time to have a significant amount of life insurance from a death benefit perspective. And Mark, you actually asked about taxes. We don't worry about taxes on the death benefit itself, but we need to start worrying because at the end of next year, at the end of 2025, our tax rates are going to go back to what they were in 2017. And estate taxes are going to rise again. And we may have $5 or $6 million. If your estate is above that, you'll be paying estate taxes. And people say, well, man, $5 or $6 million. But if you have $2 million, even $1.5 million, $1.5 million, $2 million in your assets, and you're in your 50s or early 60s, the rule of 72 says in 10 years, that can double at 7%. In 7 years, it can double at 10%. So you think about doubling and doubling and doubling, and you're not using that, and you're living on Social Security, and maybe you're taking some of the RMDs out and required minimum distributions out to live on, your estate can escalate very quickly. So we also need to look at life insurance from a estate planning perspective so that Uncle Sam, the IRS, isn't your biggest beneficiary when you pass.
Which is a great point. So what we're talking about now are not the couples who are raising young kids and still need to cover their debts. These are the couples that probably don't have any debt left anymore. And if they do, it's like, I have a couple thousand, I'll throw on a credit card here or there, whatever. But if they have a large estate that they're leaving behind, and for estate tax purposes, this includes your primary residence. This includes everything you own.
It includes your IRAs, your 401ks. It includes everything.
If it's over 5, 6, we don't know the exact number, by the way, because they're going to be inflation adjusting it. But it's probably going to land somewhere around $5, $6, $7 million. If your estate is more than that, you'll not only owe income tax on everything that's not life insurance, but your estate will also owe estate taxes on that. So there are creative ways that you could plan for that estate tax and that income tax while using a death benefit of life insurance.
And you can guarantee that your beneficiaries will be your family as opposed to an entity that is knocking on your door every April 15th.
We really look at the taxation of how much your estate is valued at. We project out assumptions. We don't have a crystal ball. We have no idea what it's going to be worth in the future. But we can project out assumptions with you and help you figure out what kind of coverage would you need so that those taxes are taken care of with a tax-free benefit in the form of life insurance death benefit in the future.
God forbid something happens, you go through a divorce, don't forget to change that name on that. You've said that before. That can be a big problem.
We've run into that before.
There are a lot of people that need to change beneficiaries for a multitude of different reasons, but you always need to make sure that on at least an annual basis, you're doing a beneficiary review of everything you have, but especially that life insurance. I did one of those with my husband not that long ago, and he realized that his dad was still the beneficiary of a couple things, and he was like, "Oh shoot, I just realized I didn't change that when we got married." So,
but that happens a lot. We see that a lot, especially
absolutely.
when you do have assets. Early on, your 401k, maybe some life insurance. When you're single and all of a sudden you get married and you just forget, you don't even think about that. So we absolutely want to do that annual review and make sure beneficiaries are up to date all the time or as life changes.
Well, yeah, if you add a member to your family or one of them goes away from death, divorce, whatever the case may be, you always need to make sure you're keeping that up to date. So that's a great point, Mark.
Somebody's listening right now. They're saying, you know what? I need to put together a life insurance plan. What's the first thing that we should be doing as adults?
As adults, if you have debt of any kind, the first thing you're going to do is make sure that if you have coverage through your employer, it's going to, at minimum, cover your debts. If you don't have coverage from an employer, you need to open up a term of policy or a policy of some sort to cover your debt. That's step one.
Then step two is, what happens in the event that I'm not here anymore? What's my income going to, what my income replacement, what's it going to be like? What's my spouse going to be faced with respect to covering their expenses? So you need to make sure that your income replacement plan is there as well.
If you're just a single adult, you need to make sure your debts are covered no matter what so that debt doesn't fall on whoever your next of kin is. If you're married, you want to make sure your spouse is taken care of. If you have children, you want to make sure your children are taken care of. And if you're in your older years and you don't have any debt, it might be worth a conversation to make sure your estate is covered so that Uncle Sam and or the IRS don't become your biggest beneficiary, but your beneficiaries and your family are the ones that are best taken care of moving forward.
And you can always get more information and have this conversation when you reach out to the team at rickenfinancial.com, RICKEN financial.com. Of course, you can find that link right here in the show notes. We said this was going to be a 2-part episode, so next week we'll have another episode of Kicking with the Rickens talking more about life insurance and your living benefits. So we'll get to that. Look forward to that next week. But for now, that's going to do it on this conversation here on Kicking with the Rickens, rickenfinancial.com. Before we get out of here, finish this one up. Every day
is a holiday.
Life is short.
Laugh hard.
So thanks for listening. This has been Kicking with the Rickens, redefining retirement.
Insurance products are offered through the insurance business Ricken Financial LLC. Ricken Financial LLC is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Ricken Financial LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Ricken Financial LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Ricken Financial LLC.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.